Hi everyone, welcome back to the channel. We are continuing today the merger and acquisition series, the basic questions. Previously, we have discussed about the merger and acquisitions. Uh, how does a merger and acquisition look like? So let me just give you a quick recap of that. So this is what a merger and acquisition model looks like. Basically, there are four tabs in the model: acquirer, the target. We have forecasted the acquirer and targets model. Using those two models, we have made the performer model. And before the performer model, we have actually assumed and done some analysis so that it would help us to create our performer model. Also, previously, we have discussed about the types of the impact, the about mergers and acquisitions differently, difference between mergers and acquisition, and why would a company acquire another company, or what why would an acquisition be dilutive or accretive? And is there any thumb of rule, which we follow when we are talking about acquisition, uh, whether the acquisition will be accretive or dilutive? And previously we have discussed about the price to earning ratios. So price to earning ratios is only relevant in a all stock deal. In a cash or a cash and debt deal, we have discussed that, see, if you are having cash in your balance sheet, so or if you have cash in your bank account, so there is going to be an interest component which will be a income for you. And if you are using debt in your if you are using debt I mean anyhow, or any kind of debt, then you there is going to be a interest component that you actually have to pay. So accretion and in dilution, uh, how do we manage the interest here? Is that in accretion, the interest is added to the expense from any new debt, and the opportunity cost of the cash, and then comparing the total against the target's pre-tax income. If the target's earning exceed the cost, the deal is likely accretive. If it reduces the cost, it's dilutive. So if earnings exceed the cost, it's accretive. If earnings do I mean the cost exceeds the earning, then it's a dilutive. Then the EPS is going to be dilutive. In an all stock deal, the price to earnings ratio is relevant because acquirers PE to the target's PE ratio. If the acquirers PE ratio is higher than the targets, the deal is generally accretive, and if it's lower, then the deal is dilutive. And when we are doing a mixed deal or a hybrid deal where we are using cash, stock, and debt, so there is no simple shortcut, because here in this situation you actually have to do a detailed model uh, to determine whether it's accretion or dilution. And we were to start question number six today, and which is linked with question number five only. So if we look at question number six, the company with higher price to earnings ratio acquire one with lower price to earning ratio. Is this going to be dilutive or accretive? Accretive or a dilutive? So it's going to be accretive or dilutive, or whether it's the EPS is going to be accretive or dilutive. So let's break down it step by step, by getting a detailed understanding of why P/E ratio alone do not determine accretion and dilution. So accretive deals, buyer's EPS increase post acquisition, and dilutive deals, buyer's EPS decrease post acquisition. And EPS impact depend upon how acquisition is financed and the relationship between purchase price and earning contribution. The role of price to earning ratio is when we are comparing price to earnings in merger and acquisition. So if buyer's PE is higher than the target PE, And if it's all stock deal, so this means that buying cheaper earnings and usually increases the buyer's EPS and then it's accretive. And if you are a buyer, if you are buying price to earnings ratio less, I mean, if the buyer's price to earnings ratio are lower than the target PE, so you are acquiring more expensive earnings and this might decrease the earnings per share. So that's why it gives a dilutive impact. So the logic only applies if the stock is used to if the stocks are used to pay the acquisition. That's because EPS changes when new shares are issued. The second point here, which you need to consider here, is the deal structure matter actually. So if it's a all stock deal, the buyer issues new share to fund the acquisition, and the EPS is affected because of the denominator increase. The PE logic applies here. So lower target PE relative to buyer accretive and higher PE ratio to the target, higher target to PE ratio, it's been dilutive. And in an all cash deal, buyer pays cash. So instead of issuing shares, so no shares are created. So EPS denominator doesn't change. So PE ratios are irrelevant in those cases where it's all cash deal. And all debt deal also similar logic applies because EPS can be impacted by additional interest expense, but price to earnings multiple themselves do not determine accretion or dilution. And if you think about it in more detail, so even if we have synergies or one-time charges or share repurchases, in all stock deal, these factors can affect EPS. So cost, if we are considering synergies, so synergies have a cost saving or revenue enhancement impact and can make the deal accretive even if the target has higher PE. And if we think from a one-time charges perspective, so restructuring costs, integration expenses, or amortization of intangibles can temporarily reduce EPS. And every if so, we are talking about shares, and if there is a share repurchases, and if the buyer plans to buy back shares, then they that can offset dilution. So the key points to remember here is that the never rely on PE alone. It's a clue. It's a clue, but not a guarantee. So check the deal structure first. So it's whether it's stock or cash versus or debt. So it's critical to understand that what the deal structure is and consider EPS formula. So EPS formula is accretion divided by dilution. So post deal EPS, or we subtract post deal EPS and we subtract the pre deal EPS. We need to understand this thing, and we also have to adjust for synergies, financing costs, and one-time expenses to get the full picture. So never make any assumption that lower PE means it's going to be dilutive in nature or it's going to be accretive in nature because it's higher PE or lower PE. That's only sensible when it's an all stock deal. If anything else in the deal structure, then we actually need to have a detailed analysis of those things. So I hope this was clear. Now let's move to question number seven. So question number seven is about what is the rule of thumb for assessing whether an MA deal will be accretive or dilutive? So in a stock deal, if the buyer has higher PE than the seller, it will be accretive, yes. And if the buyer has lower PE, it will be dilutive. And on an intuition level, if you are paying more for earnings than what the market values your own earnings at, you can guess that it will be dilutive. And likewise, if you are paying less for earnings than what the market values your own earnings at, you can guess that it would be accretive. But now understand this thing from an accretion versus dilution in merger and acquisition point of perspective. So when companies acquire another company, one key question investors and management ask is whether the deal will increase or decrease the acquirer's EPS, earning per share. And if EPS increases, the deal is accretive, and if EPS decreases, the deal is dilutive. And one common intuitive rule of thumb, it involves comparing the price to earning ratios of the buyer and the seller in the stock transaction. So all stock deal if it's a all, so understand it from an all stock deal mechanism. So in an all stock deal, the buyer issues new shares to pay for the acquisition. The effect on EPS depends on the relative valuation of the buyer shares versus the seller shares. Uh, then, if you compare the price to earnings comparison, so if the buyer's price to earning is greater than the seller's price to earning, it's accretive. If buyer's price to earning is less than the seller's price to earnings, it's dilutive. We understand this. We have discussed this previously also. So intuitive way would be thinking, the intuitive way to think about it would be that imagine you are buying earnings. If you are paying less than the market valuation for your own earnings, you are getting a good deal, boosting your EPS. If you pay more than what the earnings are worth, EPS will likely be dropping. So this concept works well in interviews because it demonstrates actually the conceptual understanding of why price to earning matters and practical awareness about the role of the deal structure and synergies, and also the ability to communicate technical concepts clearly. So when you are answering about these kind of questions, always pay attention. So previously they were asking about, is there a rule of thumb for calculating whether an acquisition will be accretion or dilutive? So question number five, and we if we go about question number seven, what is the rule of thumb for assessing whether in an merger and acquisition deal will be accretive or dilutive? So both of these questions are answered similarly, and we have discussed that in detail now. So I hope this made sense. And the common rule of thumb is to compare the buyer's and seller's price to earnings ratio in an all stock deal. If the buyer's price to earning is higher than the seller's, the transaction is generally accretive. Yes, but if it's a all, we have discussed in question number six, if it's a, sorry, it's in question number five, if it's a all stock deal, if it's a all cash deal, we need to figure out the targets, whether the targets earning are exceeding the cost or costs are exceeding the targets earning. And if it's a mixed deal, well, get back to question number seven. If it's a mixed deal, then we actually have to make a detailed forecasted model for that. Question numbers five, six, seven are actually related in a sense. They are actually asking about accretion and dilution. Let's move to question number eight now. So, what are the complete effects of an acquisition? Okay, so complete effects of an acquisition. So first of all, as in the answer you can see. So absolutely, let's break it down. The effects of acquisition in detail, conceptual and structured way, so you can carefully understand not just what happens, but why it happens and how it impacts the financial statements and company operations. So the first point here is foregone interest on cash. So foregone interest on cash means what actually happens, why it matters, and financial statement impact. What actually happens here is if the company pays for acquisition using the cash reserves, it actually loses the opportunity to earn interest or investment income on the cash. So yes, that's pretty much obvious. But why it matters? Because this actually was an opportunity cost. Even if the cash is sitting idle, accountants would consider the lost potential earnings as per of the economic effect of the acquisition, and financial statements will also get impacted because cash decreases on the balance sheet and there is no immediate profit or loss effect, but the company's future interest income is lower because of foregone on cash. If you're using cash in the in the process of acquisition. So second point, let's move to second point. Now let's talk about the second point here. Additional debt, interest on debt. And if you're using additional debt, so there is going to be an interest component which will be added. So if acquisition is financed with debt, the company takes on additional liabilities and will need to pay interest on the borrowed funds. And this will further on increase interest expenses, which will reduce the net income and can impact the credit metrics like EBIT to EBITDA, debt to EBITDA, and lenders and investors watch closely this. So debt to EBITDA ratios actually are monitored by investors and lenders. And the financial statements impact will be also there because liabilities increase on the balance sheet and interest expense increases on the income statement. This will actually be reducing the net income. So if you are using cash or you are using debt, so the overall the impact at the end is you are going to have a uh, so here you are going to have a lower interest income. Once you have foregone the interest on cash, additional interest on debt means that your net income will be reducing. If the third point here is that if you are using impact on equity, if you are using if acquisition is paid with stocks, so company issues new shares for to the sellers, and this issuing of new shares diluted the ownership percentage of existing shareholders, and this can affect metrics like EPS. So if you are funding your acquisition with stocks or equity, so this is going to reduce your EPS, future EPS, and the shareholders' equity increases due to additional common stock and possible additional paid-in capital, and while EPS may decline due to larger share base. So the combined financial impact on the all the statements after acquisition. So the buyer, if consolidates the financials for the target company into its own, and yes, there is going to be a combined financial impact because the buyer is actually going to uh, consolidate the financials of target company into its own. And this means that the revenue, expenses, assets, and liabilities of the target are now part of buyer's financial statement. And this affects the key ratios like debt conversion and investor perception. And the balance sheet grows with the target's asset and liabilities. The income statement reflects combined revenues and expenses. And potentially, it actually increases total profit or if the acquisition is profitable. And the goodwill and other intangible assets. So, if purchase price exceeds the fair value of the target's net assets, the exceed is recorded as goodwill or other intangible assets. And goodwill actually represents the premium paid for expected synergies, strategic value, or market position, and it is not amortized but must be tested for impairment annually. So the impact of goodwill and intangible assets appear on the balance sheet, and impairment in future years could reduce net income. So overall, an acquisition actually affects cash flow, the capital structure, earning, and the balance sheet. While there are additional nuisances like deferred taxes, contingent liabilities, or synergies, uh, these 5 points, above 5 points, actually pretty much cover everything. So we are not talking about deferred tax asset, synergy, or integration cost, or contingent liabilities. Or let's talk about a little about these components. So deferred tax assets is the difference between the book value and the tax value of the asset and may create deferred tax liabilities in assets. Uh, Synergies we have discussed. The synergies are actually cost savings or revenue growth from combining two companies and are expected but often uncertain. If two companies are combining and there is a cost saving or revenue growth, that's called synergies. There is a contingent liability that any pending lawsuit or obligation of the target might become the buyer's responsibility now. So if some target company was in legal troubles, so now it's the buyer's headache now. And deferred tax contingent synergies. So that's pretty much it. And integration costs are, if you talk about integration costs, some short-term expenses may also rise due to structuring, like layoff or IT system integrations. So I hope so. Yet again, we are discussing about cash, debt, or impact of equity. Previously, also, we have discussed the impact of cash, debt, and equity on accretion and dilution. I hope that with every question, you are actually revising these concepts one more time and you are starting to understand these concepts. Even though we have not started with our merger and acquisition model, but pretty soon when we will start a live valuation of merger or acquisition model, you will be needing these concepts. In journal, you might have heard of merger and acquisitions. Tesla actually did an hostile takeover. Sorry, Elon Musk actually did a hostile takeover of Twitter. That's a that is a case where acquisition was done. Facebook bought Instagram. Facebook bought WhatsApp. That was a acquisition. Maruti and Suzuki. There used to be a merger previously. So Maruti and Suzuki, if you remember previously, they used to make similar product, one product, and the full name was Maruti and Suzuki. At that time, there was a merger. So one will provide the industry, and another will provide the technology. And in recent times, ExxonMobil, we have discussed about Exxon and Mobil. So Exxon merged with Mobil. So whensoever there is a merger, both the companies get to keep their name, or they both make a separate entity, or one dominates and another doesn't. I mean, there are two, three cases. These are two, three types of mergers. And acquisition, we have discussed about hostile takeovers. We have not discussed about hostile takeovers, but in future questions, I think we will be discussing about hostile takeovers. So let's move. I hope this we have understood, and rather than digressing from the topic, let's cover our topic questions first. And when we will be doing the sector wise, or when we will be doing a merger and acquisition, then we will start with the story of why merger and acquisition all, and we will be needing these concepts at that time. So let's move to question number 9 now. If a company were not capable of paying 100% of in cash for another company, why would it choose not to do so? So if you are capable of paying 100% of cash for another company, so in a merger and acquisition, if you think about it, so preserving liquidity and managing risk is one key aspect where a company has enough cash to buy another company outright. Using all of it could leave the business vulnerable to unexpected events such as sudden downturn in revenue, rising interest or economic shocks, or unexpected expenses or investment opportunities. And maintaining a healthy cash balance is essentially a form of insurance. Executives often value financial flexibility highly because running out of cash can quickly put the company at risk. So paying entirely in cash could be seen as too risky. And since we are talking about that, the cost considers why we will not use all our cash. So cost consideration relative to stock is uh, thing was talking about it. Sometimes using stock as a part of purchase can be more attractive than paying cash, especially if company stock is trading at a higher valuation. And issuing stock allows the company to preserve cash for other strategic initiatives. And even though paying with stock might dilute existing shareholders, it can be more efficient use of resources, and essentially the company is exchanging equity that might be overvalued in the market for assets that will grow in business. So that's how it will be lucrative for the other party. And this actually is a why we do not use all our cash. In short, if even if cash is available, paying entirely in cash is really just a financial decision. It's actually a strategic decision. So company weigh risk management and liquidity, efficiency relative to stock valuation, flexibility for future opportunities, and market perception and signaling. So the goal is to balance acquiring the target with maintaining financial strength and flexibility, and that's why a company never pay 100% of cash to another company. I hope this makes sense. Let's move to question number 10 now. Why would a strategic acquirer typically be willing to pay more for a company than a private equity firm would? And the definition of the players, if we think about, so strategic acquirer, typically a company in the same industry or a related one and looking to expand market share. uh, they are looking to add capabilities or achieve operational efficiencies. And a private equity firm is actually an investment firm that buys companies primarily to generate financial returns, uh, often through operational improvements, restructuring, or eventual resale. So the valuation drivers for a strategy acquirer uh, uh, would be to achieve synergies that directly improve the financial performance of the combined entities. Revenue synergies would be there, cost synergies would be there because these synergies are realized after the acquisition. So strategic buyer can justify paying a premium over the target's standalone valuation, and an equity private equity firm typically do not have an operational business to merge with the target. So only synergies they can extract are the improving efficiency, restructuring, or financial engineering actually. And synergies tied to combining with other company only comes into play if they already own a complementary portfolio company, which is less common for a private equity firm. The implications on the price are that the strategic acquirer sees incremental value that the PE firm cannot immediately access. And this incremental value means the strategic acquirer can justify offering a higher price because the net benefit of owning the company is greater actually. Here in this case, just imagine a company A, a strategy acquirer, buys company B, which sells complementary products. So by integrating their sales team, company A can sell company B's products to its existing customers. Revenue and synergy. That's an example of revenue synergy, and also they can consolidate manufacturing facilities, reducing cost by 15%. Cost synergies, that's an example of cost synergies. So let there be that the company A is a cup company and company B is a spoon company. So cup and spoons. So if uh, A A acquires a cup company acquires a spoon company, so integrate they thereby integrating their sales team, so they can sell cups and spoons to their existing customers, and they can consolidate manufacturing facilities also. That will reduce their cost also. So that's an example of cost synergy. And a private equity firm buying a company, any company or a company like for a spoon company. Let's the private equity firm wants to buy the spoon company, would not capture this synergy unless they own another company with similar complementary product. So therefore, unless until they actually own a cup company or a bowl company. So I'm talking from the perspective of utensils. So therefore, private equity firm would only pay based on standalone performance and potential operational improvement, leading to a lower offer. So strategic acquirer can pay more because they see additional and tangible value through synergies that a private equity buyer cannot realize. And the private equity firm focuses on standalone improvements while strategic buyers can leverage integration benefits that make the acquisition worth a premium. So that's the main reason why a strategy acquirer will buy more rather than a private equity firm. I hope this made sense and this is clear now. Question number 11 is talking about why do goodwill and other intangibles are created in an acquisition? And this is actually an interesting question. Why goodwill and intangibles are created in acquisition? Because why created in acquisition when one company acquires another, the buyer records all the asset and liabilities of the target at their own fair market price. And the concept of fair market price, the price those assets and liabilities would sell for if an open market, if we are to sell those products in the open market, what would they will we sell for? So that's the fair market value. And however, in nearly all real world acquisition, the purchase price ends up being higher than the fair value of the target's net identifiable assets. That is total identifiable assets minus total liabilities, and the difference between the purchase price and the fair value of identifiable net assets is recorded as goodwill. So that's goodwill. So don't get confused. What is goodwill? So goodwill is actually if I got a product, if I got a building, and if if I am selling that building after the acquisition, if I'm selling that building at the fair market value, and there is a difference, which is a positive difference, then I will realize that value as a goodwill in my balance sheet. So that's goodwill actually, and that's goodwill and other intangibles. So if we break it down step by step, so first we start with the purchase price. We identify tangible and intangible assets at fair market value. We subtract. So tangible assets are cash, PP, inventory. Intangible assets are like patents, trademark, customer list, or technology that can be separately recorded and valued. We subtract liabilities. The fair value of the target's liabilities is subtracted to arrive at the fair value of net identifiable assets, and the resulting goodwill will represent the portion of the purchase price that cannot be assigned to specific identifiable assets. Goodwill represents non-identifiable. So, yes, goodwill reflects non-identifiable factors that drive the target's earning power, such as strong brand name, loyal customers, highly skilled workforce, expected synergies from combining the two businesses, strategic location or market positions, and other intangible assets are identifiable intangible items that can be measured and valued separately. Separately from goodwill, and those are patent, trademark, copyrights, customer contracts or databases, and proprietary technology. And these assets are capitalized on the balance sheet, and unlike goodwill, are amortized over the useful life. When to capitalize, when to expense, we have discussed about it, and we have discussed about goodwill and other intangible assets also. Identifiable and unidentifiable. And the another one more aspect that we will discuss in future is definite and indefinite. If the life of the object is definite or indefinite. Uh, okay, let's keep this topic for later on. Understand this. There are four parameters: definite, indefinite, the life is definite, the life is indefinite. It's identifiable, non-identifiable. And if you can Google these few concepts, then it would be helpful for us to keep pace in future. So let's not discuss about this right now. Let's move to question number 12 now. Let's discuss about what the difference between goodwill and other intangible assets. So the definition and origin, if we discuss about the definition, so goodwill arises only through acquisition when one company buys another for more than the fair value of its identifiable net asset. The excess purchase price is recorded as goodwill, and it represents the value of the intangible benefits that cannot be separately identified or quantified. And things like brand reputation, strong customer relationships, and employee expertise are what the goodwill includes. And if we talk about the definition of other intangible assets, are specific identifiable assets that can be recognized separately from goodwill, and these could include patent, trademark, licenses, customer lists, or proprietary technologies. And essentially, any intangible can be individually valued during the purchase price allocation process. Yes, goodwill is Goodwill, we do not amortize goodwill, so we test annually for the impairment, and therefore goodwill usually remains constant for years. While the other intangible assets, they actually have a finite life and they are actually amortized over that useful life. And some intangible assets, like certain trademarks, do not have indefinite life. They are not amortized, but they are also tested for impairment, just like goodwill. For financial statement, from the perspective of financial statements, so goodwill is a one-time non-cash charge on the income statement, and it reduces net income and total assets. While amortization of intangibles is a recurring non-cash expense that lowers pre-tax income every year, similar to depreciation for tangible assets. And why it matters in finance or valuation? Because in valuation or modeling, analysts often add back amortization of intangibles since it's a non-cash and the acquisition related. While goodwill impairments are treated as non-recurring items, and understanding these distinctions help analyzing merger and acquisition deals, purchase price allocation, and quality of earnings post-acquisition. So this is the major difference between goodwill and other intangible assets. Goodwill is actually not amortized, but instead impaired, tested for impairment and amortized other intangibles. It depends whether they will be amortized or tested for impairment. If it has an indefinite life, it will be tested for tested for impairment. If they have a definite life, they will be amortized. Indefinite, definite, tangible, intangible. Goodwill and few of the intangible assets are it's in the name only. All right. So let's move to question number 13 now. So question number 13 is there anything else intangible beside goodwill and other intangibles that could also impact the combined company? And yes, when a company acquire another business, the purchase price is allocated to the target's identifiable assets and liabilities at fair market value, fair price. Most people immediately think of goodwill and other intangible assets like trademark, patent, and customer relationship, but there are also other intangibles or accounting related adjustment that can affect the combined company post acquisition. And two important examples are the purchase in process R&D write-off and deferred revenue write-down. So if purchase in process research and development write-off is refers to research and development projects that the acquired company has started but not yet completed at the time of acquisition. And these projects are considered intangible assets because they have potential future economic benefit, but they are also incomplete and carry uncertainty. And under accounting treatment, under purchase accounting rules, the acquirer must value these incomplete R&D projects at fair value because the acquirer R&D is not yet complete and will require significant future spending and technical efforts to finish. Accounting standards often require the buyer to expense the value of this in process research and development immediately after closing, and this results in one-time non-cash charges on the buyer's income statement. The rationale is that since the acquirer's RA research and development is not yet generated, the revenue and still needs and is not yet generating revenue and still needs investment to be completed, it should not remain on the balance sheet as a long-term asset. And the impact it creates is it will be immediately expensed. It will lower the reported gap earnings and does not affect cash flow since it's a non-cash accounting adjustment. And the another point is the another thing with besides intangibles is deferred revenue write-down. So deferred revenues are actually unearned revenues representing cash received by the target company for goods and services that have not yet been delivered or performed. And a common example would be software company that has been paid in advance for annual subscription but has not yet provided the full year service. So during in acquisition, deferred revenue is recorded on the buyer's balance sheet at fair value, not necessarily the target's book value, because fair value only reflect the cost to fulfill those obligations. Uh, the buyer typically records a write down of deferred revenue. And in simple terms, if seller had say 100 millions of deferred revenue, the acquirer might not record 70 to 80 million on its post acquisition balance sheet. This prevents the buyer from double counting revenue. Once when seller originally collects cash, and again when the buyer recognizes revenue after for delivering the products or services post close. And overall implication here is that both the purchased uh, intellectual property research and development write-off and deferred revenue write-down are non-cash accounting adjustments. But they can significantly affect the reported gap earnings, generally accepted accounting principles of US, and make post-acquisition results appear temporarily weaker. And analysts and investors often adjust for those effects by get to get a clearer picture of the company's underlying operational performance. So that's so those 2 points, the R&D write-off and deferred revenue write-downs. These are the two common examples purchased in process R&D write-offs and deferred revenue write-downs. And this is how they are actually treated. Let's talk about question number 14 now. So what are synergies? When we have discussed that, the cost synergy and revenue synergy, then what are these? Can you provide with a few example? So synergies refer to actually additional value that is created when two companies combine in two companies are combined. So in other words, when 2 plus 2 is 5, the idea is that the combined company is worth more than the sum of the two standalone businesses. And there are two major types of synergies, revenue synergies and cost synergies. So revenue synergies occur when the combined company can generate more sales than the two firms could separately, and cost synergies. These come from eliminating the redundancies and achieving greater efficiencies. So these synergies are generated in the case of strategic buyers or strategic sale of businesses. So these are the two inner examples of two cost synergies. I hope this was we have discussed this synergies concept previously also, and here we one more time we have discussed it. I hope this was clear, and there is no trouble understanding the concept. And in short, synergies are what make many acquisitions attractive. They help justify paying the premium by showing how the deal creates more value than either company could on its own. And question number 15 is again about synergies. How are synergies used in merger models? If so, in merger models, synergies represent the incremental value that can be created when two companies combine. Value that would not exist if they remained independent. So they are critical because they often determine whether a transaction is financially attractive or creative to earnings. Two main types of synergies are revenue and cost synergies. And overall rule in merger and acquisition is that when building the combined financial, the standalone income statement of both companies are added together. We have seen that in our in when we discussed about let me just so in this case the performer model, what we are doing, the standalone income statement of both companies are added, then adjustments are made for synergies acquisition of so there are going to be acquisition Synergies will be there will be going to be adjustments made for synergies and other changes. Debt, we are going to make changes for interest on debt, foregone interest, and interest on cash, net new shares issued, transaction accounting, and finally, performa EPS. We will drive the performa EPS. Let me just show you the performa EPS. This is the performa EPS after calculations. So the key driver of synergies are actually the key drivers of deal economics. They can turn an otherwise dilutive deal into a creative one and often justify the premium paid to the target company shareholders. And if we think from an integration of cost and realism, so it is important to account for integration cost also, one-time expenses required to achieve the synergies. Examples would be severance, system integration, and rebranding. So these costs usually appear on the cash flow statement and can reduce the near-term benefits. But in practice, most analysts model both gross synergies, that is total expected benefits, and net synergies, that is after accounting for those integration costs. And synergies actually represent the additional value created when two companies merge. And in a merger model's revenue synergies are added to the combined company's revenue and flow through the income statement at an assumed margin, boosting profitability. Cost synergies are modeled as, as reductions in cost of goods sold and operating expenses, which directly increases EBIT and net income. Both types of synergies increase earning per share and can make a deal more accretive. And analysts often treat cost synergies as more reliable, and they will also model integration cost to reflect the real net benefit also. So, so that's how synergies are actually incorporated in a merger model. Don't get confused. This is very important and a not just very difficult for those who have no experience in merger and acquisition, because see, there are different verticals in finance and everyone cannot work in all of these. Not one person cannot work in all of these verticals, but you need to have knowledge of all these, because when a deal is happening, you use all these kind of valuations. You should be aware about how the dynamics of merger and acquisition work, how the dynamics of valuation or DCF works, discounted cash flow work, how uh, precedent transactions and comparable comps work. So you need to understand everything, then only you will be able to make sense. So all the very best learning, and I will see you in the next session. For today, let's wrap it up. We will meet in the next session and we'll start from question number 16 onwards. All the very best learning. And if you have learned something of value today, kindly subscribe to my channel and please invest some time in these videos, because your learning never goes waste. Thank you. Thank you.